I think that you have to ask on which countries you're looking at. If you look at Germany, secondary and tertiary cities are already in the focus of a lot of investors. Looking at the UK, the investors are moving back to these cities because of the historical yield gap they've seen in this market. And I would say, yes, the weight of capital is forcing a lot of investors getting out because they simply want a certain yield level they cannot find in the major markets anymore. The only question I would pose to these investors: do they have the structure in place to really manage the assets they are buying into? Because if you're buying, the question is, do you go for B location in A city or an A location in a B city? That's a discussion you have a lot in Germany right now, and I think you increasingly see this in the other European countries due to the weight of capital. But I would more or less for a lot of cross-border investors, the question is, if I go to another country, do I have the teams or the structure in place to really look at the secondary or tertiary cities in a way that I can be sure what type of properties am I really buying there? Because liquidity is definitely lower, although it might return to a certain extent. But you have to be aware of, it's not that easy to sell a property in secondary or tertiary cities that it is in London, Paris, or Frankfurt, Munich. And that is something, depending on the strategy you're going forward, where you have to be careful what to do. And additionally, I think retail will be one of the things that people would go first before they really go for the secondary office.